Ladies and gentlemen, good day and welcome to the investor conference call of Rishi Laser Limited. We have Mr. Harshit Patel, Chairman and Managing Director, Mr. Ganesh Agarwal, Chief Financial Officer, and Ms. Vandana Patel, Company Secretary from management team of the company. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harshit Patel, Chairman and Managing Director. Thank you, and over to you, sir.
So, welcome to the investor Concall. Thank you for taking your time to attend this. And the annual results are before you, and there was a small presentation also which was put up a couple of days back, which I hope you all have been able to go through. I think one quarter back we had a meeting where some of you all would have also attended. And since then there has not been much change as far as business outlook is concerned. So as far as last year was concerned, we had a very benign growth in sales, just about under 5%. And this was primarily, as we mentioned earlier as well, the second half was a little bit slower. Typically, second half is slightly better than the first, but in the last year, second half was lower, and therefore we were a little bit below our targeted sales. However, profitability was better, and with little bit more operational improvement, I think the profitability should get better even going forward. Besides this, I think not too much more to report as far as business is concerned. I think customers are all stable. They are growing, and we expect much better business from them going forward, especially in the second half when some of the development work which we have done will be through, and those will be commercialized. As far as exports are concerned, which is very low as of today, only single-digit numbers. We have 3 large customers for export, one from Australia and 2 from United States. And 2 of them we have already started supplies, and commercial orders are in place. And this business should go up significantly after the third quarter onwards. Raw material scenario seems to be very benign. I think I don't expect any problems as far as steel pricing is concerned. A lot of large steel capacities are coming on stream in next 6 months. So that should be okay. And typically with stable raw material prices, it helps maintain profitability, because it's the large volatility in price, especially on the way up, which causes a little bit of a problem, as we have seen in the past. So I don't expect that also to I think that should also be quite all right. The other thing is setting up a very large new plant in Bangalore, about 30 kilometers away from our existing facility. And this will be, in fact, the largest setup of the company, larger than our current big facility at Pune. And this should get on stream towards the last quarter of this year. The other new thing is that so far we have only been in flat steel processing business. So our starting material is flat steel. It could be anything CR, HR, or stainless steel. But now we are getting into round and square steel processing, that is tubes. And our first, machines which will process this should be with us by second quarter. From third quarter onwards, that will be a new business. We see a very, very large potential in that business because India is still quite undeveloped as far as tube processing is concerned. A huge amount of tubes are being produced, but still not being processed with modern techniques the way we are able to do with flat steel. So that beginning will also be made sometime in third quarter of this year. I think this is all about last year and what we plan to do in the current year. And with this, I think we can open up for questions from the participants.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask questions. The first question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity and congratulations, Harshad Bhai, on improved profitability. And as you in your initial remarks, you mentioned about top line growth coming on in the second half. Harshad Bhai, if you could spell some details about what exactly we are talking about when we say top line will be much better in the second half. What will drive that growth in sales for the second half? That is my question number one.
Yeah.
And within that, if we can spell about the segmental, because the construction equipment for last 3 years has been around 75-80 crores, whereas our power business has grown from 6 crores to 14 to this year to 24. It has done well on a yearly basis as well as quarterly basis. So what exactly is happening on the power segment side, and going ahead, how do you look at both these segments? And within the segment, the others category, if you could talk about what is a major part in the others and where the growth will come in the other segment.
Okay, got it. Yeah, so thanks Rahul for attending. The top line growth in the second half we are talking about more optimistically is because mainly because of exports coming online. This has been going on for, work has been going on this for about 9 months to a year in some cases. And those are steadily, going up initially from smaller lots and to containers, and now it will start becoming regular. So the primary growth will come from there. The other area where we hope to see good growth in the second half is from the off-road construction equipment. That are these large dumper trucks. So that used to be our biggest segment within the construction equipment sector. Our biggest customers, our biggest demand was from the off-road mining, the vehicles used in the mines. And that was not growing that fast. Last 2 quarters it has been slow. It is expected to be a little bit slow even another 2 quarters. And after that our customers are expecting a good amount of growth from that sector. So it will be from this off-road vehicle mining sector as far as domestic and export is concerned, and also exports per se to the other industries which are not from the construction sector. And segment growth, I think See, electricals used to be many years ago a very strong focus area, and we had expected a lot of business from there, but that had not fructified. Primarily, we are in the medium voltage distribution sector. We don't supply anything to the power generation industry. We used to do a lot of work for in the past for hydel projects and stuff like that with Alstom, but now our primary customers are from the switchgear industry, voltage, that is Schneider is the larger customer in the electricals. But more other customers were added, and that is, Schneider has not seen that much growth, but they are projecting very large numbers again going forward because of, in fact, as the situation stands today, they have a lot of order backlog which they are not able to fulfill, primarily because they are struggling with some imported components to make those. So once that thing is stabilized, then we expect decent growth from the electricals sector as well. But I still feel that the construction equipment and electricals, the ratio that we saw in the last year, it should remain something similar. Because both these sectors will see growth, but I think construction equipment sector will see higher growth than electricals is my feel. So maybe the percentage of sale to electricals will go down as compared to the past this year ended March 24, and construction equipment percentage may go up slightly. Though the sales in both sectors, sales in numbers, rupee value will be higher, but as a percentage there will be slight change again in favor of construction equipment as compared to the electrical. As far as others are concerned, we have companies from other equipment builders like compressor manufacturers, and whenever we talk of any of these equipment, these would always be the larger segments, not the consumer or the individual user segments. These would be primarily large compressors which go in for industrial use, right up to big ones, very big ones which go into the steel plants and cement plants and stuff like that. So that's one area. There are some customers who are in water processing and pumps areas. Then there are customers who are in the windmill sector. And I'm not sure whether last year I think windmill was also included in whether in this percentage it is included in the power, and because of that the power segment has gone up. I'm not very sure about that. So I think this is as far as the distribution of sales is concerned. Okay, can we go to the next question, please? Thanks again for asking this. Yeah.
Thanks, Harshad. This is quite helpful. I'll have some more questions, but I'll come back.
Okay. Thank you. Yeah.
Thank you. The next question is from the line of Ankit Kanodia from Smart Sync Services. Please go ahead.
Yeah. Thank you for taking my question, and congratulations on good set of numbers. And sir, I really appreciate in the recent presentation we have shared the product portfolio as well, which is very helpful. So my first question is related to the export numbers. So when I see export has actually grown a lot in this year, but on an absolute basis, I think it is still about 8 to 10 crores, right?
Right.
So just wanted to understand more color as to what kind of export order, and this order would consist of how many clients, customers. Is there only one or two customers who is forming part of the whole export, or is it diversified? And if it is diversified, how can we have such a small export order? Is this just a sample thing which they are doing with us, and maybe larger order we'll get based on the review of our current this thing? That would be very helpful, sir, if you can share.
Right. Yeah. Thanks, Ankit, for joining. So your analysis is absolutely correct. This export growth looks big because the base was very small. It's on a very tiny base, so it looks as if there has been some growth. But this is just, I would say, just tip of the iceberg. It's just an entry being made. Primarily, there are three customers on whom we are banking for exports. Currently, we have more than three, but the growth will come from these three customers. One is Emerson, which, as you know, Emerson Electric is a very big, large American group. And there the initial exports have already commercial exports have started. So that will grow significantly from here. The other one is an Australian company which is making equipments for glass processing. So these are again components for that equipment which are being exported. And this we have been working with them for again maybe something like 5-6 months. And the first commercial order has just come in this current month. And once these things get set, we expect that also to pick up. And the other one is our main customer, even in domestic market, which is Caterpillar. Caterpillar, we have exported parts to two of their plants in the US. And now they are they've given us orders for their aftermarket components. So these are components which will be stocked by them for spares and sold in the US market because these are small in volume, so they cannot source it domestically or from China or anywhere. Of course, small in volume is as far as Caterpillar size is concerned. For us, it's not a very small business. So these are the three major. Besides this, we have customer in France and also I forget in what line of business they are, but we've exported some stuff to them last year. So exports is a very big area which is untapped actually, and we also had not been able to get into that because of our own issues and which we had. And exports, it's a little bit long-term thing, but a good part of that distance is covered. So your thinking is absolutely correct that 2 crores, 5 crores and all that in export is very small. Any one customer can take you to 15-20 crores quite easily. That's the kind of business potential that they talk of. And in fact, what is happening is that what we are seeing now in the last 6 months, more and more foreign companies are trying to look at India more seriously as far as steel fabrication exports are concerned, because the costs in Europe especially have gone absolutely ballistic. So today the cost of steel fabrications from India is less than 50% of the cost of what they are able to do in let's say Germany, or in fact even in Poland, France, all these countries. So more and more they are under a lot of cost pressures, and they have to look at India quite seriously. Now, what actually happens here is that your first few customers to get and to do the business becomes little critical, because later on the customers, once you have credibility in the market, then the other customers, you don't have to go through the whole process of their long gestation and their people coming here and auditing and all that. Once they know that okay, you are already a supplier to top grade companies, so once that credibility is established, to expand that business will become much easier, which I think will happen not in this coming year, but the year after that. This year we'll consolidate business with the customers whom we've already tapped, which should pick up quite substantially. But in the coming years, if this what trends I see, exports could grow so much that it could be as big or even bigger than the domestic business. That's the kind of potential which I see in the exports business.
Thank you so much, sir. That was very helpful to share a detailed answer on this. So my second question would be related to our upcoming capacity in Bangalore. So, if I remember correctly, in the last call, you mentioned that we are only having a 50% capacity utilization currently.
Right.
And on top of that, if we are going for such a high CapEx, is it right to assume that there should be some product mix shift towards more high value-added products there? Or will we be making the same kind of products in that facility as well?
Right. No, see, actually, we have various plants, as you know, in different parts of the country. And because of skewed nature of our capacity and demand, it is funnily where our largest facilities are in Pune and the second largest facilities in Gujarat. These are underutilized, whereas our facilities in Bangalore and Chennai, the business is more than what we can handle from our existing factory. So that is the reason for setting up this unit in Bangalore, because we actually in the last year we have lost some businesses because we didn't have enough space to do that business, some bulky businesses, and currently we have three small units just abutting our existing factory, which we have taken on rent as a temporary measure to because the business had gone up more, so we had to use that temporary facilities nearby. But that is very inconvenient because you have two or three small shops supporting our main shop in Bangalore. That is the reason why we have gone for this big facility. So we will move our major customers' business to the new facility, as well as now we are changing a little bit way of working, in the sense that we will consolidate. Today we have all our factories have entire facilities from first process to the last. That means you take steel and you can make the final product. Now we will be changing slightly the way we do business, and in the new plant there will be a very large cutting facility and cutting shop, which will supply parts to our Chennai factory and our current Bangalore factory. So with this consolidation, it will sort of increase our capacities in our existing two plants, because some space will be released. Plus, with this new space being with us, we expect some more business to come from a couple of new customers who are in electric vehicles, not passenger vehicles, but small vehicles made out of battery operated vehicles, load bodies and few other things. So those kind of some new businesses, but primarily more of the same from similar customers, as well as export also will be done from the new facility. So no new product as such. Of course, the tube business also we are talking of will also go into the Bangalore facility. And tubes is a very large. It's another very big animal and a very large business. It's little initial stages, and I think this is a little too early for me to give a very detailed presentation on that. But as we go along, maybe another 2 quarters from now, that we can discuss that also a little more. So as far as new product is concerned, it will be tubes and pipes. But major part of the business for the new facility will be from existing customers and export. So the excess capacity is not in the southern plant. There we had constraints of space. That is why the new facility is being put up.
Got it. Yeah. So then when we are looking more towards export and believe that export will increase in a much faster space compared to our domestic sales, are we also planning some facility near the port areas like Bhuj or Kutch, where there are ports? Are we planning something like that?
No.
Are we fine?
No, we are not, because see, our business, our work is not that way, that bulky that we need to be near the port. What is important in these businesses is your technical knowledge of all this, because ours is not a process industry, as you know, it's all discrete manufacturing. So the human resource and other things are very, very important. That's why these plants we cannot put up, in faraway places, away from, that's the reason our plants are also in big cities, whether it's Bangalore or Pune or Baroda, etc. We are not, in Chhattisgarh or near a steel plant in Bhilai or something like that, or near a port. So no, we do not look at. For us, we cannot go. I mean, it doesn't make sense to go near a port like that.
Got it, sir. And sir, I see our fixed asset turnover is very low at 2 times, but I think this is majorly because of low utilization level, right? If we reach closer to 100% utilization,
yes,
where can we go in terms of fixed asset turnover? If we take also the increased capacity of Bangalore, which will come up in the next 1 year.
Yeah, so the Bangalore facility itself will be about 70,000 square feet. So for us to get that plant also fully occupied will take about 2.5 years. It's such a large facility. So the reason for going for a large facility was that this area was available, and if we do small area expansions, we are finding that we are always running short of space and continuously in a building mode. And our layouts also, we cannot plan that efficiently. So that's the reason we've gone for this. So as far as, the Pune capacity, space-wise and equipment, with some equipment being added itself, has capacity of doing more than maybe 150 crores in that larger facility. In the past, we have done that also. But in the downsizing and all that, we had to cut down a lot of our sales. The other thing, as I had mentioned in the previous meeting, is that we have changed our entire strategy of sales and got away from more higher volume sales. Even within the earth moving industry, there are lots of components which are high in volume and sales value, but the value addition is lower. So now we've tried to move away from that, and that is the reason top line growth, even going forward, will not be very fast unless we decide to again get into those markets. But I don't think as of today we don't have that. Since we have vacated that space, we don't feel it is better to get back into that, because that is more competitive. There is business, but it is too competitive and too much volume driven. And whenever we've looked at very high volume driven sales, the cycles and the up and down hurt us much more rather than when we are a little bit more concentrated and focused on certain areas. So the infrastructure wise, we have a very large infrastructure already in place to do much larger sales, but despite that, the sales growth domestically will not be that high, and that is also the reason for getting into the tubes and those kind of businesses which are also in steel, which are related in one way, because similar infrastructure companies and other areas we can supply tubes and pipes. So growth we want to do more in a balanced way with some newer types of components and assemblies, rather than have very high volume growth in high volume markets.
Got it, sir.
Yeah.
That was very helpful, sir. And sir, regarding the kind of growth which we are expecting in the coming years, how are we placed in terms of funding? How do we see our funding going forward? Is our internal accrual sufficient, or are we going to increase our debt and equity funding? Any broad guideline on that? How do we want to move ahead?
Actually, last year in September we had become debt free, and then after that we have taken some small loans because of capex requirements. So going forward, also at least in the coming year, a good part of growth, whatever we've planned, will be out of internal accruals. There will be some loan requirements also. So unless there is some very large business or some related area of business which shows more promise, then only we may think in terms of having some small equity infusion. Otherwise, with internal accruals and some debt, we'll be able to fund whatever our. Last year we had, I think, about a 10 crore cash flow, and a good part of it had gone for repayment of previous loans in the first 6 months. And now current year cash flows also, this will be there, plus maybe some borrowing will be made to finance this whatever capex we are planning.
Got it, sir. So one last question. Generally what we see in India, whenever any industry, or specifically industry which is smaller and niche like ours, see any good growth, we see a lot of new players coming in and competition heating up. How do you see that coming up in the coming years? How are we prepared for that?
Yeah, so I think this is a very valid and a very good question. There is, as of today, as we speak, there is a kind of a gold rush in the cutting business. In the laser cutting in India, the capacity is growing manifold, in the sense that in the last 2 years, the capacity of cutting in India must have grown by maybe 500% or something like that. It is that many equipments are coming in, and so large number of people are getting into the cutting business. Some of them will get into the fabrication business as well. But fabrication business, the kind of business, this business has its own gestation. This is not it's not a question of setting up a factory and putting 4 equipments in place, because when you talk to at least all these big organized players, the entry barriers are very, very high. In fact, though we are in this business for 15-20 years, for us to get into newer companies also is very, very difficult, because many big companies have stopped giving vendor codes to new people. They don't want new vendors. They are in fact shrinking the number of vendors that they have. So to that extent, I would say that competition from newer players, I don't expect that much. But the opposite of that is in fact happening, and that is that consolidation is taking place, and the smaller players in this business are in post-COVID. There has been a very big transformation happening. So even in who are vendors of these kind of companies that we work with, there has been a lot of shuffle. The small players, when I say small, I would typically talk in terms of single location company doing business of about 25, 30, 35 crores. These are the companies, many of them are taking a big hit because they are not investing enough in new technologies and or investing in people. So competition, I don't feel competition will be the problem. Which, if at all arises, is that the growth in our customers. Our customers, if they don't grow enough, it could be a problem, because all the existing people in the business, everybody looks to grow. So if your industry is not growing, it could be a problem. But all the new players who come in, they are typically only looking at the very low end part of the business, which we have already vacated that space. We are no longer in that space at all. Our company's main foundation used to be cutting. That's where we made all our money, and that was the base on which this company was built. But now that has become completely commoditized, and as I told you, huge expansion has taken place. So I don't see that as a serious threat.
No, that was very, very, very helpful, sir. Sir, one last question, if I may.
Please. Yeah, we need to go to the others also. Yes, please. Yeah.
Just last question, sir. If we take a very longer term call, say 4 or 5 years down the line, what is our general aspiration as a company? Where do we see ourselves in the next 3 to 5 years? And what do you think is the major risk to reach that aspiration, which we'll always keep in mind based on our experience in the last 20 years?
No, we are still not aggressive as far as growth is concerned, and that's why I think another 1 year more. This current year also is going to be critical because we have taken decisions to expand capacity to get into a newer line of business. So how this pans out will tell us what we could do in 5 years. So moving very cautiously, because though I am very, very optimistic about the business scenario, also even more in tubes than in flat steel, but the beginning that I'm making is in a very cautious way. I mean, the same thing maybe a decade ago, I would have gone with all guns firing. But now I think the way we want to move forward is, not to be over. I would say to keep little bit of enthusiasm in check and take things as they come. And yes, if things look much better and we start getting results of whatever we are doing, then yes, we can press the accelerator as going forward. But as of today, I cannot really tell you in more detail about 5 years from today what could be the scenario.
No, sir. Thank you so much. That was very helpful, and all the best.
Thanks, Ankit. Yeah. Thank you so much. Yeah.
Thank you.
Yeah. Can you go forward, please?
Yes, sir. The next question is from the line of Dhanil Desai from Turtle Capital. Please go ahead.
Yeah.
Hi. Good morning, Arshad sir.
Good morning.
So my first question is, if we look at the, our trajectory in terms of, gross margins, I think we have done very well even in tough times. And as we are coming out of tough times, I think the gross margins are even improving. And as you are saying that we are focusing more on non-commodity products, export market, which generally, we believe is a higher margin business. So sir, with that 45% kind of a gross margin, generally as the growth comes in, the operating leverage is pretty high. So, first question is, do we see gross margin remaining at around this level or improving? And as we grow at 15-20% or even more, do we see our EBITDA margin reaching to, low teens or around mid-teens kind of a number? Is that the direction that you are thinking about?
Yeah, so very good question. You've really hit the thing on the head. So yeah, gross margins we expect it to remain in these levels, and that is those are the types of businesses that we are looking at. Only if we are able to get businesses which have that kind of complexity or the quality demands from customer due to which these margins are there, then only those businesses we are taking up. And in future also that's the kind of business that we would like to take up. And the problem here is that to increase sales very aggressively with this kind of products is proving to be much more difficult than I had envisaged. Because some of the customers, though they are very large, their capital spends are very large. What we are supplying to them is still very, very small, and it's still not that easy to increase, I think, sales there unless their own growth also. I mean, for example, ABB you would have heard as a company, again a very, very big player, also our customer, but still we are very small in that space. So to do this business, I think growth will be fast growth may be slightly challenging unless more of this churn takes place and some of the smaller players continue to get under pressure. But otherwise, yes, our target is to maintain these margins. So if we can increase turnovers, then we'll see EBIT. This kind of business should theoretically give you double-digit EBIT margins actually. But because our turnover is too small for the size of the company, for the size of the facilities, number of plants, etc., is the reason we are at these numbers. If we could grow more, then yes, it will help at EBIT level.
Okay, got it. Sir, second question is on the steel tubes, and I understand that you are still kind of, it's a gestation period and you are still looking at various options.
Right.
But at a broader level, wanted to understand, from whatever limited understanding that I have, steel tube is there are reasonably large players, and I also assume that there will be many product SKUs, many applications. So within that, there are already established players, what is it that we are looking which is so exciting, where we can make our, good margins and still scale up? So, in the given scheme of things and competitive landscape, and since we are new player, why do you feel that we will be able to kind of, get into this area and scale up well?
Yeah, so this is, see what has happened is in tubes, since you are from the investor community, you would be seeing the kind of growth that is happening in the tube industry. When I talk of tube industry, it is the people who are making tubes. But post-tube, the processed tube industry is not keeping pace with that. So we are still processing those tubes in a very crude manner, and India is exporting a large number of these tubes and pipes from India going into various industries, whether it's petrochemical or so many other industries. So the reason I am optimistic is that we are going into a space of tube processing, not actually making tubes. In the tube processing area, lot of processing is being done with very crude technology. In fact, I am seeing today that 15 years ago, where we were in flat steel in India with much more outdated ways of processing, and now it has changed completely. Something similar will happen even in the tube space. So the areas we will be looking at will be tube supplies to equipment builders, equipment makers. We are again not going to go in the competition or the demands where we are. India is already very strong is in automotive space, in two-wheelers and all these areas. Tube usage is very good, suppliers are very good. But we are looking at those industries, and we are looking at the furniture industries, the hospital equipment, hospital industries, tube requirements in stainless steel. So what we are looking at is that the existing market is being served not in a sophisticated manner, and we want to come with the latest technologies and equipment so that our quality delivery will be much better. That's the reason I'm so optimistic.
Okay. And the last question. So again, given the backdrop that you talked about both on domestic market side and export market side, in the domestic market, some of the end user segments have, some push or tailwind or, some kind of a demand push, be it infrastructure, construction, real estate, and on the export side, you are seeing customers wanting to source more from India.
Right.
So given all that and the base that we are sitting at, which is a very small base of 130, 140 crores, why do you see a challenge for us to grow at 20% plus? And if so, why? I mean, where are the bottlenecks?
Yes, I do see a challenge, or rather, I have discovered now that it's much more challenging than what I thought it was 2 years ago. 2 years ago, my feeling was that, market is a big market is there, and once we get our finances and other things in place, growth should be, there's a lot of opportunity for growth. But I'm not finding that. We are definitely struggling to add customers to our profile. So we can grow at that pace. If we want to grow at 20% or 20% plus, then the only way to do that is to add customers to what we have, and that part is proving to be very difficult, because as I also in today's talk itself said that in the large customers, the kind of customers we are addressing, they are all trying to, they are limiting the number of players who enter into their space, and therefore it is proving to be very difficult to grow faster. And that's the reason why we have shifted our focus much more to exports than to the domestic market.
Okay. Got it, sir. That's it.
It may seem to be a little contradictory, but that's what we find. So, or otherwise, we have to think a little bit differently and compromise and say that, okay, we can, with these similar customers or similar types of customers, we go in for lesser value-added products, and we grow top line faster, and we have a product mix of where gross margins are 45-50%, and we also have products where there are just gross margins of maybe 30%, and that kind of a mix, that is also a possibility if you want to grow faster. That is definitely possible. But if we want to continue with this kind of thing, then it is a little challenging to grow domestically that fast.
But with export coming in, from what you are saying, if it scales up, then it adds up to the domestic growth. So if that part, starts scaling up, then we can go to 20% kind of a growth. Is that a right assumption?
Absolutely. That's correct. Absolutely. Yeah. Thanks. Yeah.
Thank you. The next question is from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yes, Ankit.
Yeah, sir. Yeah, thanks for the opportunity. Sir, on the margin side, we have seen that there has been an improvement in the margins, primarily because our expenses haven't grown much in the current year. So around 8.5% is what we have done this year. So given the growth that we are expecting in the second half of next financial year, and traction across the various industries that we are serving, how do you see margins panning out for us for FY'25?
Yeah. So as far as margins are concerned, two major things. One, we talked about gross margin, which is variable cost to sale. So that part. Now when we come to the fixed cost or the semi-fixed cost, the major concern will be human resource cost. And it is a little bit human resource intensive, the work we do, because it's all tailor-made. So in that area, I see that is one area of concern which I see, because one is the lack of skilled manpower availability in this country. So we are investing a lot on our own, setting up a separate training facility in Gujarat to train more people for us and for others in the industry. But to contain that cost, we have set up a separate task force just to look into automation, and we want to go for increased automation with robotics and other simple special purpose machines or assisting machines, etc. So idea is to keep manpower numbers at the same level and increase sales from here by 50% or 60% from where we are, and not add any people. So that's the target. And with this in mind, current year, this month itself, we are installing a new robot in place in our Bangalore plant. And similarly, we will be automating so many processes as we go forward. So idea is by doing some of these automations, especially in robotics, initially appears to be commercially not that attractive, because manually you are not spending so much on capex, and you can say that, oh, work is going on, why spend so much on these automations? But as I see, unless we do it now, you'll always be behind the curve. So yes, human resource cost is the major concern, and that we are very aggressively working on that to keep that in control.
Sure. Because we have seen some increase, we have seen a decent increase in our employee expenses, almost 15% in FY'24 compared to FY'23.
Right. So those costs are going to increase. Two reasons. One is, of course, the minimum wages are going up, and that is going to be putting pressure throughout the entire value this thing. And then even for the better quality, the more educated staff, engineers, etc., those availability numbers is very high, but good quality people to retain, you'll have to pay them far better. So that's why the only way to attack this is through automation and other things. So even our back end on software design, manufacturing, engineering, all those areas also we've been fairly weak in the past because of underinvestment in software. So that area also we are attacking. So but that I'm quite confident we'll be able. There is a lot of low-hanging fruit there, and we should be able to keep that in check. It doesn't appear to be, though it's an area of concern, but I think we will address it. I'm not too worried about that.
And sir, given the kind of growth expectations we have for the second half of FY'25, for the full year FY'25, how do we see growth for us?
Sorry, I didn't get that. Can you repeat, please?
The kind of growth that we are expecting in the second half of the next financial year.
Yes.
So how do you see the overall growth of the company in FY'25? We ended this year at 140 crores. So next year, what kind of growth can we expect?
I think I'll pass, because I don't want to give a number and then not be able to sort of achieve that. But as we discussed earlier also, the growth will not be very aggressive, in the sense of anywhere between around, you can say on an average maybe 15%. That would be a good growth as far as we are concerned.
Sure, because we are setting up our Bangalore plant as well. So
So that is also unfortunately coming up a little bit, in the later part, only in the third quarter of this year. So the benefit that and the benefit of that in current year may not be that much as it will be in the subsequent year. So that's why, as I said earlier, if these things happen and go as per plan, then the subsequent year or 2 years should be much better. The growth should be faster.
Okay.
Yeah.
And sir, how do you envisage growth with our, larger customers on the construction equipment side? You're saying second half should see better, but let's say over the next 2 to 3 years, this business has been in the range of around 70-80 crores. So do you think this business has a potential to reach cross 120-150 crore over the next 3 to 4 years?
It should, because these are all as far as domestic business is concerned, these equipments are all going into road building and mining and all other infrastructure projects, including dams and all other kinds of stuff. So if these infra spending continues at this pace or even slightly lower pace, the business should grow from here, because even today our infrastructure equipment industry is very, very small compared to China. We are maybe less than 1/5 the size of China in this space. So the customers But one thing has happened is many of our customers have been very over-optimistic with their projections in the past, and they have not been able to meet that because of too much cyclicality in the business, volatility. So customers are quite optimistic. They are all building capacities. Volvo is expanding, Caterpillar is expanding, JCB is expanded, put up a new factory. So all of them are growing in the expectation of more business from India and their own export business. But we have to see, what will happen. In the past, last 10 years, things have not been. It's always been up and down. We have not had consistent growth for 4-5 years in a row. So that, in that sense, it is a little worrying. But I think growth, it will come. Now, how fast it will come is a question, one has to answer. And again, one more thing which, therefore, what happens is that you have to be ready for that kind of big growth business to come, because once the business comes, there is no time to set up facilities and, get this equipment, get that, do that. So, you have to build capacities and keep that ready in anticipation of growth, and that is something that even companies like Caterpillar, who have deep cycles in their own business, is what they are telling vendors to do. And that is also the reason why they say that you should have more and more automation, so that you have flexibility in ramping up and ramping down. You don't have to throw too many people out or again rehire them. So this whole plan of building capacity and keeping all that is to see that when the times, when things pick up, you are ready with your capability.
Sure. Okay. Thank you, sir.
Thanks, Ankit. Yeah.
Thank you. The next question is from the line of Pradeep Rawat from Last House Blue. Please go ahead.
Yeah.
Thank you for the opportunity. And so I have a couple of questions. So first question is regarding our revenue potential. So what is our revenue potential from our current facilities, and what would be the revenue potential from the upcoming facilities?
Yeah. See, this, it's a little difficult for me to answer this because it all depends on what business you are going to do from that facility. So, as such, one large plant, okay, let me answer that question in a slightly different manner. Today, we have a plant in Pune, which is maybe 3 times larger than Bangalore. But business being done there is less than half of Bangalore. So that is the potential to do more business is there. So with this new facility in place and all the existing setup, actually with balancing equipment and people and all that, it can be scaled up very substantially from here, in the sense of 250-300 crores business the whole company can do with these kind of facilities.
Yeah, both current and upcoming facility, right?
Yeah. It can be even more than 300 actually, but 300 is something that is definitely, doable if the business comes in or we are able to get the business on board. And therefore, again and again, I revolve back to export, is that I feel that those kind of larger volumes in a shorter period of time will be possible more outside India than in the domestic market.
Yeah, so we are expecting huge revenue ramp up from exports, like you said, 40 to 50% plus kind of contribution we can generate from exports. So can you specify any kind of ballpark timeline for that?
It is difficult for me to say. I would say about 3 years is what I feel.
Okay. And that would be like serviced from our Bangalore facility or all over the, all facilities that we have?
So primarily Pune and Bangalore. Pune also, and Bangalore. Because these two facilities, because of the quality of people that we have, more than people, and now in future infrastructure also.
Yeah. And my question regarding that CapEx only. So what kind of investment are we putting into that new facility?
The new facility, see, this total maybe 7-8 crores, maybe under 10 crores of capex in that facility. And balance, we are also upgrading some of our other equipments as we go. So our routine capex will also be there. And as I talked about automation, so this automation capex is also going to be an ongoing thing. So with all this, everything, it could be around 12 to 15 crores, which would include, the existing facilities as well as the new facility.
Okay, so 2 to 5 crore would be for routine capex and automation.
Yeah, yes.
Okay. So my last question is regarding our competition. So, sir, can you name some of our competitor in current line of business as well as the new segment we are getting into, that tube processing segment?
Tube processing, I'm not really sure of any big organized players what they are doing so far. But in this current type of business, there are very good strong companies in the south, in Coimbatore area. There is in Jamshedpur, Bangalore. Most of these are one or two single plant companies, and again supplying to these earth moving industry, railways, and these kind of industries. So there is these are our other sort of suppliers in the similar line of business. It could be many of them are in automotive components also, Apex Auto or Surene Auto, and Model Infrastructure. These Model and others are all closely held companies. They are quite strong in this area, earth moving equipment, maybe doing about 400-450 crores business. It's a Singapore funded company. And so there are players all over the country because this whole steel processing business is a very, very large business, and it's likely to grow larger because of the kind of facility, kind of steel capacities which are coming online. And there are a number of players. I think off the cuff, I'm just not getting some of these names.
Yeah. So, sir, you are saying that tube processing segment have no significant players. So, can you specify?
No. I'm not saying that. Please don't mistake me. I'm not saying there are no significant players. There are obviously such a lot of tubes are being processed, so there have to be significant players. But the work, the way it is being done, the number of players are still very limited. There are few in Pune. As I said, many of them are suppliers in the automotive space, but the non-automotive space, I have not found that. I don't see that many big players. There are a few companies now which have got into it for bigger kind of tube and this processing, very large, which are used for bridges and stadiums and airports and those kind of things. But that is not the space that we are still looking at the smaller diameter, maybe 50 millimeter, below 50 millimeter and below. So those players seem to be all quite small, small and scattered. Possibly maybe because the demand scenario in India has not been so large, and it's all the tube is from strength to weight ratio. Tube is one of the best ways to bear load, and therefore in the West more and more work is being done with tubes than with other kinds of steel like angle channels and other things. And slowly and steadily that is going to happen in India as well. So that's but as I said, tubes is a new thing, so let's not spend too much time in that thing as of today. Maybe 6 months down the line or 1 year, we'll be able to talk about that from our point of view. But it's a very large segment. Yeah, can we go forward, please?
Thank you, sir. We'll take the next question from the line of Manoj from Geometric. Please go ahead.
Good afternoon, sir. I am audible?
Yes, please.
Okay. As export is going to be major growth driver, can you throw some color on the gross margin? We are taking these three big customers, so we know the customers which can drive the growth also. So how would we what is the working capital cycle, inventory, how do they order, how much before they tell? Just color on these kind of key metrics which we track specifically for the growth in export.
No, I don't. Ganesh, you have anything on this? You can say.
Yeah, the margins are better than the domestic customers, basically by 4-5%. That is on the margin side, and working capital requirement is equal to what we have for domestic customers.
Okay. That was my only question. Thank you.
Yeah. Thanks.
Thank you.
Yeah.
Thank you, sir. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to Mr. Harshit Patel for closing comments. Over to you, sir.
Yes, I don't have anything much to say. We've discussed in fairly good detail, but I hope that when we meet maybe 6 months down the line, there will be something more to discuss. Otherwise, there's nothing from my side actually. Thanks all of you all for joining and joining and taking so much interest in our business.
Thank you very much, sir. Thank you, members of the management. On behalf of Rishi Laser Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.